About the only certainty in these most uncertain times is that Europe's debt crisis poses the biggest immediate threat to the global economy, and there's not a solution to the problem readily at hand. And this was highlighted by the knee-jerk ban on short-selling financial stocks in France, Italy, Spain and Belgium, while Austria has just been outed as the next precariously wobbling domino that could fall. To get an update, I spoke to Citi's interest rate strategist Stephen Mansell from the trading floor in London as the week was winding up. Well, Steve Mansell, do you think that the ban on short-selling bank shares announced on Thursday will actually calm things down?
I think it's extremely unlikely to be effective, to be honest. Short-selling bans in the past have rarely worked, if at all. We've seen them before in both the bond and the money markets. As it happens, equity markets have stabilised today, but I think it's more due to the fact that we've had such sharp falls over recent days. It's interesting to note that the pressure's actually now shifted into the credit default swap market rather than equity prices per se. Where there's an underlying problem, I think the markets will find a way of expressing this. So the short-selling ban is nothing more than the politicians trying to shoot the messenger again.
Well, how are the financial markets behaving as we speak?
Well, the credit default swap markets are pricing in much higher risk in the banking sector in Europe because of clearly the extent of cross-border ties between French banks and banks in the peripheral markets. French sovereign CDS has widened very sharply, reflective of the fear that there may be a downgrade in France to follow what we had in the US. I think that's extremely unlikely, by the way. But also this morning we have the Austrian CDS market widening sharply as well, and that's reflective of the fact that Austrian banks have significant exposure to Eastern Europe. That's probably more of a concern, I would say.
And on the other hand, Switzerland is being flooded with safe haven money, which is driving their currency up, and their government's trying to do something about that. Yeah,
there's some talk of the peg. I mean, it's really reflective of the broader malaise in Europe. It's a euro breakup trade where money's been flooding into the front end of the Swiss market. In fact, this week we've seen negative short-term interest rates in the LIBOR market in Switzerland. It's clearly a big problem for the Swiss economy, but I don't think there's going to be much to be done about this either.
Does it remind you of 2008?
In some ways, yes, but in many ways, no. I think the policy response that we've had over recent years has been quite substantial, particularly in the UK and in the US. I think in Europe we now have a broad measure of the extent of the risk. Politicians are always a little bit slow off the mark. I think in this sense, this is why the markets have tried to sell Italy and Spain, why they're trying to reprice credit default risks in France. But I do sense that we're not about to fall down the abyss. We're looking at perhaps a period of very slow growth, but not recession. So in many ways, there is a difference between what we went through in 2008 and today.
Well, a lot of people are talking about the breakup of the euro as being a sort of Armageddon scenario. What do you think about that? Do you think the European Monetary Union will survive?
Yeah, I think we have to remember that the single currency is a political animal. The economics have always been somewhat questionable behind the whole idea of a common economic area. We don't have labour mobility. We clearly don't have a homogeneous group of economic countries at play here. But I think the solution will be political as well. The stakes are just too high to allow fragmentation. It's in nobody's interest to leave the euro area, not even for Greece, for example. So we will potentially have a realignment. Perhaps we might have a move towards surrendering of fiscal sovereignty in some of these weaker areas. Maybe common European bonds might make an appearance. But the euro as an entity, a currency entity, will remain in place, I think. There's just too much to lose by breaking this up.
Actually, some people are talking about France and Germany leaving the euro rather than Greece.
Well, imagine that. I mean, if we had Germany leaving the euro, we would have a very deep recession overnight in Germany. The currency, the Deutschmark, would appreciate through the ceiling, and for such an export-driven economy, it would be suicide. So I don't think that's a runner as a scenario either.
You mentioned before you don't see a recession in Europe. Now, we've just this week seen industrial production figures for July, which are down quite heavily. That didn't change your mind?
No, I mean, it's absolutely true to say that the economic surprises globally have been on the downside, at least in terms of real economic indicators. for most advanced developed economies. It's not good news. I think that we are entering a period of much lower growth. This is more than an inconvenience for those countries trying to consolidate their fiscal positions. But Germany is in a very strong, relatively speaking, fiscal position compared to some of the other countries in Europe. So it's not good news, but on the other hand, it's not likely to push central banks to change their tack in terms of policy initiatives. So slower growth is not helpful. It makes the solution more difficult to achieve, but recession-type scenarios, I think, are some way out in the future and very much a tail risk rather than a central scenario.
Well, do you think the calm we're seeing right now in the markets today will persist into next week?
That's a very difficult question. I think we're in the eye of a storm. The ECB's initial salvo into the secondary bond markets this week, buying Italian and Spanish bonds, was clearly a response to the market's disappointment that they didn't do the same in the previous week when they just attempted to buy some of the weaker peripheral debt markets, Italy, Portugal and Ireland, when the problem was really with the larger Tier 2 countries in Europe, which are suffering flat or negative growth and are much larger. But so far we've had a small drop in the ocean. As I said before, the solution to the problem is actually to put fiscal policy on a more sustainable footing in both of these economies. Initially that might have a negative impact on growth, but as we've seen over the latest weeks, we now actually have much lower debt financing costs in all of the markets in Europe.
Well, thanks very much, Steve Mansell.
You're welcome. Thanks very much.